Be the change you want to see. Make a difference by giving your money a purpose, a mission to do good. Welcome to Money with Mission, where we talk to individuals, businesses, and organizations who are taking the lead and whose actions are impacting the well-being of their communities and the world at large.
Welcome to Money with Mission. Today, I have with me Neil Wahlgren, who is Chief Operating Officer at MAG Capital Partners. He came to MAG Capital Partners with 2 decades of leadership and experience in operations in capital markets. Prior to joining MAG, he had worked with a Bay Area real estate investment firm and had raised over $200 million for their projects. Prior to that, you're in the Air Force? Air Force or Navy?
Air Force and then the Navy, actually.
Air Force and, okay.
A little unusual.
Dual service and as a pilot, and flew combat tours in both Iraq and Afghanistan, and concluded his military career as a lieutenant commander. We can get into that. He now lives in San Francisco with his fiance and son and enjoys flying and sailing. Welcome, Neil.
Well, thank you so much, Felicia.
Thanks a lot Thanks. Okay. Why Air Force and Navy? Let's just get to something that I want to know.
Great question. Well, I joined the Air Force originally right out of high school. Went to the Air Force Academy with the goal to fly. It seemed like the most logical track there, and I had a great experience. I flew the C-130 Hercules, which is a small, kind of robust cargo plane.
Okay.
And in 99 countries all over the world. And when it was time to scale that back a little bit, and I looked at how I could keep doing it part-time and realized the Navy also flies the same planes and all their bases are right on the water. So it sounded like a much better fit.
Okay.
So I switched to the Navy and spent the last 3 or 4 years of my flying career just outside of Malibu, California, where the Navy has a great base down there.
Is that a very common thing to do, that people serve in 2 different branches of the military?
Certainly not. No, I was the only pilot in my unit who had done that.
All right. So a lot of pilots that I know that now fly commercial flew in the military. That is not the track you took, it doesn't sound like. Did you ever fly commercial airlines, or you went right into real estate investing and that kind of work?
No, I considered it for a bit and just decided I think I liked the entrepreneurial track a little better. So I actually had one stop in between for a couple of years down in Southern California. I worked for a soil and renewable energies startup just outside of Los Angeles in a town called Camarillo.
Okay.
So I was working as a project manager and then in the business development role. And we actually had a technology where we could take excess waste feedstock and also woody products like forest residues and actually compress them under heat, turn them into a vaporous form of hydrocarbons that you could end up putting through some catalysts and turn into the gaseous form of gasoline. And then the byproduct was this dark granular, it looked like charcoal actually, but cooked at a much higher temperature, called biochar. You could actually amend soil in a very permanent way to increase the holding properties and really build up that soil to a better quality.
That's really interesting. So that sounds pretty environmentally friendly.
Yeah.
From what I think I understood of that, sounds like a lot of chemistry and a lot of stuff going on there. You got your education while you're in the military, a BS from the Air Force Academy. And did you get your MBA after you got out, or were you still in when you did that?
I actually got my MBA while I was in, so through Texas A&M there.
Okay.
Yep.
Okay.
So really that started the spark and made me interested in, looking at some, I would say more investor and finance savvy directions after flying.
That's really, because I'm just now thinking about it. I don't know very many, and I don't know a lot of pilots, but the ones I know aren't investors. You have to really talk to them and get them to understand that. So it was your actual formal education that got you there, or what got you into the investment world, specifically the real estate investment world?
Yeah, no, great question. To me, it really comes down to your appetite for risk. Flying, it's a great career, and I have a lot of friends and colleagues still in that field, but it's predictable, it's dependable, it's very, it's consistent day in, day out. You're doing the exact same thing, and really by design, you have to, in order to be a good pilot in that very structured manner that you need. I found, for myself, I thrive on, a little bit more of the unknown.
Okay.
the opportunity side. And that was what initially led me to that startup, that whole environment of, you don't really know what's going to happen. You're raising money to keep business afloat at the same time. You're, building a product, selling a product, marketing a product, all kind of simultaneously. And, you're adapting really quickly. And, some folks that's scary. For me, I really, kind of that was an inspiring type of work that I enjoyed. After a couple of years of that, I had the opportunity to move back up to the Bay Area. I had family up here and had a contact who was in the real estate investment side and was kind of describing the lifestyle of, a real estate investor, especially, through the private investment syndication space as a little bit of that, unstructured. You're really kind of building your own playbook. You have a lot of opportunity if you're willing to take on, some of the uncertainties of, a lot of moving parts all at once. And, really that lifestyle appealed to me. And I really like the ability to grow relationships, long lasting ones through investors, ultimately pooling capital for projects I believe in.
Got it. When did you start in your syndication business? I mean, I know it's not your specific business, which is your business model that you have. You started that, sounded like really early. Talk about that a little bit for me.
Yeah, absolutely. So I started late 2015, early 2016. Got into that, and my previous firm had a model where we actually were exclusively investor focused. So what we would do is we would JV on a project specific basis with commercial brokers or developers who really had the skill set to put together quality real estate investments, but lacked access to investor equity capital. So our firm would ultimately put together investment opportunities in a JV fashion. We would raise that money from our investor pool and then be in as ultimately co-managers, as a co-sponsor for the duration of those commercial real estate investments.
Got it. And then you came to MAG Capital. How did you get to them?
Yeah, so one of the sponsors that I had worked with in that previous role was Dax Mitchell and Andrew G., the principals at MAG Capital Partners. I really liked their real estate investment model, how they structured these deals. I felt like it was understandable, really controlled risk in a lot of ways I didn't see in some of the other, ultimately ways to model commercial real estate investments. And, we had a nice personal fit. I think the personalities of the team really meshed well, and ultimately had the chance to come over full time. And now I'm raising the capital markets, I'm responsible for the capital markets and raising equity for our investments with that team now.
Got it. I really like MAG Capital Partners model also. We're going to take a break and come back so you can hear exactly what that's like. Money with Mission is a real estate and business investment company that specializes in finding projects that have the potential to give you a great return on your investment dollar and make an impact in the communities where we invest. Make a difference in your life and the lives of others. Go to moneywithmission.com to learn more. Okay, welcome back. We still are here with Neil, which is really exciting. He's going to explain to us now about MAG Capital Partners and their business model. It's really exciting to me. It makes a lot of sense. It's a lot of winning for everybody in your model, it looks like to me. So why don't you go ahead and explain that to the listeners, what you guys do?
Absolutely. Thanks, Felicia. So MAG Capital Partners has, I would say, a bit of a unique model in terms of it's not, there's a lot of commercial real estate sponsors who do multifamily or multi-tenant type of investments. And ours, we do almost exclusively single tenant net lease industrial investments. And what that means is several pieces. So the first part, the single tenant, ultimately you have a concentrated risk on a single tenant. And for a lot of people, that's scary because you're always taught diversity. Yeah. Spread that risk, for a multifamily, for instance, you're spreading across sometimes hundreds of renters. You always assume a certain vacancy amount, and the idea of concentrating that on a single tenant is scary. But on the flip side, if you're able to really understand the risk of that single tenant and really have a strong degree of confidence in the financial wherewithal and the credit of that tenant, you can end up having a performing tenant from day one that cash flows very well, with a high degree of certainty that that tenant is going to continue to be in operation and successful through the duration of the holding of their real estate.
Okay. So single tenant industrial, that's
So
is
single tenant net leased industrial.
net leased industrial. Single tenant net leased industrial. Okay. So I have so many questions. Talk about your model and how a seller is going to find you, how that's going to work, and the benefit to a seller to working with you guys.
Absolutely. So we've niched a type of acquisition through acquiring the single tenant net leased industrial assets through what's called a sale leaseback transaction.
Okay.
So a sale leaseback is when a seller tends to be a operating or a manufacturing company that also owns the real estate, will sell us the real estate and then turn around and simultaneously lease it back as a tenant in a long-term net lease.
Okay.
And so the structure is interesting because it actually allows the seller to free up quote unquote dormant capital that's tied up in that real estate.
Mm-hmm.
They get that influx of cash and they're able to use it in typically much more efficient fashion. So oftentimes they use the proceeds of the sale for reinvestment into new manufacturing lines, to add headcount if they're growing, to either pay off corporate debt or really clean up their balance sheet in a way that makes it more efficient. And ultimately, it's a win-win. So we're coming in, we are taking the role of the landlord, and they are ultimately transitioning from owner of that real estate to tenant. And then the net lease portion is really important. And what that net lease means, or triple net, means that they are responsible for really all the ongoing expenses, just like they were before this transaction. So they're going to continue to pay all the taxes, all the insurance, all the utilities, all the maintenance. And we actually even take it a step further and make it what's called an absolute net lease. So that seller who's becoming the tenant is actually responsible for like new roof replacements, landscaping, pavement, HVAC. I mean, really 100% of the expenses on the project stay the responsibility of that selling party.
Okay, so part of your due diligence when you're looking at a company is to see that, number one, they've been in business long enough and they have the potential to stay in business for quite some time. They really have a balance sheet that would let them continue to function even if they didn't do what they're talking about doing. Mm-hmm. But it helps them because it gives them a big cash infusion from selling their real estate. Now they still basically are functioning like an owner. They just got the cash influx to help them do the things they wanted to do, correct?
Absolutely. And that cash isn't free. That cash comes with a very strong legal contract in the form of that new long-term lease. And those leases are typically 15 to 20 years. And it's for that consistent, predictable, contractual cash flow. That cash flow stream is what we're buying in the form of that sale there.
Got it. So why wouldn't they just go to a bank to cash out, refi, or do whatever to get their money?
Yeah, great question. So there can be a lot of reasons why they would not want to go and take in outside debt. One is, how it's reported on a balance sheet. The second one is a lot of times either their business has maybe had some, ups and downs that, lenders aren't comfortable with, or they're in a, say an industry that lenders don't like to lend toward or won't lend a high enough loan to value. Okay. Typically, those corporate loans are going to be collateralized against hard assets. Right. So they might be able to borrow, say, 50 to 70% of the value of that real estate. However, if they do a sale leaseback, they can actually free up 100% of the capital of that real estate because they're fully selling it. Mm-hmm. So those are some of the early kind of reasons why. But ultimately, one of the ways we see this being really mutually beneficial is through a recently acquired manufacturing company by a private equity firm. And this is really kind of the avatar model of most of our acquisitions. So just take for example, you have a company that makes widgets, right? It was founded by, we'll call her Jane Smith. Jane started this company 50 years ago from scratch, put her own blood, sweat, tears, capital, grew this thing into a company that's doing $50 million a year in widgets. Okay. She's looking for her exit. So now she sells the company to a private equity firm, and that private equity firm buys the widget company, which also comes with the real estate. Now, This private equity firm loved what Jane did with it. They think they can continue to grow this thing at a great rate. It's got a great product, great market share, but ultimately that private equity group has their expertise in growing the operations. They can't get the returns that they want by owning real estate. So at that point, they come to us through relationships, and we do multiple deals with the same, a couple of small groups. And they'll come to us and go, hey, we just acquired a new portfolio company, came with the real estate. We'd like to do a sale leaseback. So they sell us the real estate. It frees up the capital tied up in that real estate, which they use to usually either deleverage that new acquisition or to reinvest in capital improvements, new manufacturing lines, et cetera.
Got it. Oh, that makes sense. So give us an example of a kind of company that would do this. I'm having a hard time.
Yeah, absolutely. So we closed on back in May. In June. We closed on a industrial asset in Fresno, California. It was called Initiative Foods.
Okay.
And Initiative Foods was fascinating. So it was started in 2002 by a guy named John Eatma. And John grew this thing from scratch in a very similar fashion that we talked about. In 2016, they had a huge tragedy. They had a giant fire, and the entire building burned down to the ground, to the foundation. They completely wiped out their main operations there. And it was actually the largest fire in the history of the town of Sanger, just outside of Fresno, where it was located. So monumental, what could have been easily just a devastating loss. John and them, they basically didn't lay off a single person. They were able to set up some temporary operations. What Initiative Foods does is they produce basically industrial level contract baby food. So they actually work with the fruit and vegetable suppliers. They make the baby food, and they will sell it to retail companies who put their own retail labels on it and sell to end users.
I was going to say industrial baby food doesn't sound good.
Yeah. So imagine they got the big blenders and they're mashing the peas and creaming the bananas or whatever it is.
Okay.
But ultimately, because of this, and because they, correspondingly had a large drop in revenue in the several years, they built a brand new manufacturing facility from scratch.
Okay.
So that facility had just been opened a few months prior to our acquisition. And ultimately, they wanted to, they were able to build that thing to suit. It was exactly what they needed. Operations had started, but because they had such low revenues the several years prior, they weren't able to get that, outside funding that they sometimes look for. So we were able to, really feel comfortable with the operations. We looked at the contracts they had going forward. They were doing white label for Amazon, for Walmart, and did some of their own brands as well. And really, we saw, they had already regained profitability. So for us, it made sense. We looked at the credit fundamentals and said, hey, this is a company that's kept their team together, has the same leadership team, is back into profitability, and is fully operational again. And they were deemed an essential business during COVID. Really, the state of California went to them and said, we need you guys to stay open. This is crucial that, mothers and fathers are able to, have access to high quality food for their children during this. So, because of all that, we came and we bought the real estate from them, turned around, they signed a new 20-year lease. And we feel very confident that in 20 years, that company is going to continue to be operated and making a high quality food for them.
Got it. So that's a really inspiring story. It's really exciting. You were able to help a company actually keep going when they needed to get some cash. Talk about the investor side. How do investors fare in this picture?
Yeah, absolutely. So the way these deals are structured is cash flow first. And what I really like about it is, in comparison to other asset types, for example, you have a lot of value add projects, which can be great. For example, maybe I'm buying an old apartment building. I say, hey, I think I can, really clean up these rooms. I think I can increase the rents. I think I can increase the occupancy, and hopefully I'm successful, but there's risk in that. On the other hand, we are buying a performing asset. It's 100% occupied. That lease is set up, already signed. That lease has built-in rent increases year to year. I don't have to do anything. The work's already been done. So there's a ton of work that goes in before we actually have a deal that's ready to raise capital from investors. But once that's done, the lease has been finalized, negotiated. The purchase price of the real estate has been finalized and negotiated. So we're coming in really buying this income stream that has no expenses. All the expenses is on the tenant.
Right.
So we have an extremely predictable level of cash flow coming in. So to our investors, we typically will start at an 8% minimum. And that 8%, as those rent bumps kick in year to year, we actually increase the preferred return correspondingly. So it'll go like 8% year one, and sometimes 8.5% year two, 9% year three, et cetera.
Okay.
And so that gets paid out actually on a monthly basis, because it's, again, there's not a lot of variance in the operating accounts. It's a very consistent operation because there is no expenses. So because of that, we pay out monthly dividends, and really it's almost, you could almost look at it like a, kind of an alternative bond instrument where you're buying a very consistent set of cash flows that are tied to the, essentially the solvency risk of that tenant company in the same way that you would a bond. But ultimately we're able to get better than bond yields because these are what are called non-credit tenants. And because they don't have, say, an outside Moody's report giving them a credit rate agency. So instead, we have a three-man credit advisory team on staff who actually creates a full, about 6 to 8 page document that really outlines a deep dive into the creditworthiness and really making the case of why we think this is a strong play in terms of a good tenant who's really the anchor of this real estate investment.
So a couple questions. When an investor invests with you, when would they expect to get their first return, their first check to say, okay, this thing's working?
Yeah, typically about 45 days after we close, and then it's monthly thereafter.
Okay. And then for what kind of due diligence would you recommend that someone do on a company like yours? And I don't know if there's any other companies like yours, or probably is, but before they go and invest in that company?
Yeah, no, great question. I mean, really, as coming in as a passive investor, and this is, this advice I would say is applicable for any sort of syndicated or pooled capital type investment where you're coming in as a passive LP, limited partner investor position. Really, you are putting trust in the sponsor group. So I recommend two things. The first is ask to see their track record. You want to see, hey, what have you projected in the past, and what have you delivered, and how close are they? And they're never going to be perfect, but you want to see if they're ballpark, and the ones, if there are misses, you want to understand the why. Yeah. And then the second piece, we recommend it with our investors, and I think it's a savvy practice, is start small. Do something that you're very comfortable with. Understand the flow of communication with that sponsor. See if they pay and deliver on time like they promised. And really, once you get several distributions, it's communicated well. Right there, I mean, there's a huge amount of trust building just in that, initial month or two that can occur, and it can either really strengthen the bonds with a sponsor or, raise some red flags to go, hey, this is, maybe not a group that I want to continue doing business with. So those are really the two, initial things that I think is really good due diligence for an investor when they're considering investing with a new group.
I love it. Thank you so much. One other question on mechanics. How long would an investor expect their money to be out, their full capital? Do they ultimately get their return, a return of their capital in addition to their returns on, or explain that part?
Yeah, no, great question. So these are not funds. These are direct investments, the way we structure ours. So correspondingly, our investors are partial owners in the real estate, and correspondingly, that capital is tied up in the real estate until we sell it. So our usual our hold window is typically about 3 to 6 years. Okay. Some deals we feel like we're buying the real estate significantly below market. So in those scenarios, we feel like we have a lot of equity from day one, and those will usually be a smaller hold to try to realize that equity sooner. Other ones, maybe we're buying it at market, but we think we have a really strong tenant. Now those are going to be more like just heavily securitized cash flow plays, and those will be more of the 5-6 year horizon. But when we sell, and this is common with most of these real estate structures, when we sell, we return capital first. So return that investment money, and then what's left is considered net proceeds or profits. And we split 80% go to the investor pool, split proportionally, and then 20% is our promote for managing that well during the hold period.
Got it. Another question: who buys these in the end? Who's your end seller when you're done and you're ready to exit? Where do you go?
Yeah, no, great question. So mostly Bitcoin billionaires. No, I'm kidding. But,
It's like, really?
I always like to throw that out there. No. So really, I would say that the answer to this question is twofold. First is, how do you structure an investment to be an attractive sell to any buyer?
Yeah.
And that's one of the reasons we like to hold only for about 5 years. That allows us to, if we're signing a brand new 20-year lease with the investor, if we have 15 years left on the lease, between 13 and 15 years is still considered a very attractive amount of lease term for the next buyer.
Okay.
So you've left enough meat on the bone where that next buyer, they could potentially hold 5 years and not have to worry about a releasing event.
Okay.
So for that reason, that's why we like to hold for that horizon. And then when we do sell, our typical, buying groups are either REITs. We have several publicly traded REITs, Stream Capital and Store Capital. We've done a lot of business with other private investment groups, similar to us. The third category is 1031 buyers and sellers. So oftentimes you'll have high net worth guys who, recently sold a property. They have a lot of capital, they need a place, and this type of cash flowing, really net leased investment is a nice fit for those type of investors as well.
That's really good. I like it a lot. I really love this model. And for businesses that may be struggling a little bit in this with their revenues, but are strong businesses in this environment, this may be a perfect option for them. They own their real estate to be able to keep functioning the way they want to function.
Absolutely, yeah. And I will mention, the drop in revenues was unique for Initiative Foods there, but a lot of the sellers in that recently acquired private equity model, a lot of times those are, very just consistent, profitable companies.
Okay.
Just the private equity backers of those manufacturing companies, they do a cost benefit analysis and they say, hey, we're performing fine and we can get outside financing, but we can make better use of, basically fully extracting the cash in this, in this real estate asset through a sale leaseback. So, I would say the majority of our tenants, our sellers who become tenants are actually have, a pretty strong history of profitability, but it still makes, the most sense for their private equity backers.
Got it. So for Money with Mission, this is how I see this. As an investor, you are helping an owner of a business pull cash out of their real estate so that they can keep their business functioning. A win for that seller or for that business owner. For investors, we get to help that owner. We get to reap a benefit from that, from return on our capital. We get our capital back at some point in the future, assuming everything goes great. Things don't always go great, but the majority of time with this model, it looks like, when I'm looking at your guys' track record, you guys have done a pretty good job. Now, and you've also built in the exit where people who are going to want to buy, and you set up your thing from the beginning to sell. Right.
Absolutely. Yeah.
Makes perfect sense. I also know that you guys one of your founders does some, what's the word? I'm going to say has his own mission in things that he invests in outside of this. And I call a lot of charity, I call it investing, because it is an investment in something that's going to not necessarily give you a monetary return, but there's a return in some kind of way. Talk about that. Dax, is that his first name? Remind me.
Yeah, Dax Mitchell is the founder of Mag Capital Partners. We have an interesting dichotomy. So Dax is a Texas resident, but also spends a lot of time in Southern California.
Okay.
And so I always joke that he wears his cowboy hat to the beach in Malibu, and he wears his board shorts to Dallas. But really, what's funny is one of his passions, and mine as well, is the mountains. And so he's an avid snowboarder, and really kind of connected on that in terms of his private interest for how he deploys a lot of his investment capital personally. And so we have a motto of putting in 1% of corporate profits toward what's called POW, is Protect Our Winters. And they're a nonprofit environmental group, and we actually also put into the Wounded Warrior organization. So that one's fairly well known and really takes care of a lot of troops. And who come back from the deployed areas. And, we have, I think, 2 or 3 folks just on our team alone that are veterans. And so, yeah, really cause is close to our heart. And we like to, kind of redirect some of the capital that we earn personally toward those causes. So.
Perfect. Win, win, win. So listen, Thanks so much, Neil, for coming on. If you guys want to learn more about Neil and MAG Capital Partners, go to moneywithmission.com. We'll have something there for you to learn more about that. I really appreciate it, and we'll see you next time. I hope you enjoyed the interview and are inspired to give your money a mission. Until next time, send your investment dollars into the world to bring you a financial return and improve the lives of others.
You've been listening to Money with Mission. There are projects happening right now where you can make a great return while positively impacting the lives of others. To learn more about today's guests or to download 7 steps to building resilient wealth for women, visit www.moneywithmission.com.